This is the Brave New Coin Crypto Conversation, hosted by Andy Pickering.
Hi everyone, Andy Pickering here. I'm your host and welcome to the Crypto Conversation, a Brave New Coin podcast where we talk to the people building the future in the Bitcoin, blockchain and cryptocurrency space. Hello everyone, Andy Pickering here. Welcome to the holiday edition of the Crypto Conversation. We're republishing some of the best episodes of 2021. This one is back, from back in February with Sergey Nazarov, of course, the co-founder of Chainlink. And in this podcast, Sergey lays out his thinking on DeFi, how it improves on CeFi, what role oracles have in decentralized finance, and what he calls the fast and slow cases on what is needed for DeFi to go mainstream. And you know, it's always a pleasure, of course, to speak to Sergey because no one goes into the kind of depth and detail and kind of clear thinking quite like Sergey. So I reckon you'll enjoy this. If you haven't already heard it, man, you will enjoy this, and it shows where DeFi is going and will go. And so I think there's lots of alpha, lots of value in this podcast. So, all right, let's get into it. Just before we do that, let's quickly learn a bit about our wonderful sponsor, Prime XBT, and then we'll hear from Sergey. Prime XBT, of course, is an award-winning Bitcoin-based trading platform with over 50 assets, including crypto, forex, commodities, and indices. And to provide the highest level of liquidity, Prime XBT aggregates feeds from 12 industry-leading exchanges and data providers. Prime XBT offers high leverage going up to 100x on crypto assets and as high as 1000x for the traditional markets, with an interface that is suitable for both professional and beginner traders. Prime XBT is also home to a co-vesting platform which allows users to apply the copy trading strategies of the most successful professional traders. All right. Just check them out today at primexbt.com. There'll be a link in the show notes, of course. But for now, it is on with the show. Yeah, boy! My guest today is Sergey Nazarov. Sergey, of course, is the co-founder at Chainlink, where he is spearheading the smart contract oracle revolution. And it's always a little bit special when we get the chance to talk to Sergey. And in this podcast, he lays out his current thinking on everything from Robinhood and what happened with Wall Street bets traders to DeFi, how DeFi wins, and the fast and slow cases for how that happens. And of course, what role oracles have in making DeFi's CeFi future possible. All right, take a deep breath, get comfortable, pour yourself something decent, and strap in. This one goes deep. Hello and welcome back to the show, Sergey.
Good to be here again, Andy. Thank you for having me.
So lots to talk about today, Sergey. So we've just been talking, and I understand you've been following the Wall Street bets, the Robinhood, the GameStop saga. So that's a very topical issue at the moment. So let's start with that. What does all this mean? What does it mean for DeFi, for decentralized finance? How does Chainlink fit into this? Take us away.
Sure. I think the Wall Street bets phenomenon is really injecting a number of key points into society's collective consciousness. And I think some of those points are just beginning to become understood now, and others, as they recur, will only become understood as other cases prove them to be that way. I think the first and most dramatic realization that people are having, which is actually the realization that blockchains have been about from the beginning, is that they do not have control. People believe they have control over their financial assets. They believe they have control over their trading accounts. They believe they have control over their financial life and financial future. And it's not just a plaything of a larger economic system, which in many cases takes value from smaller actors, the average person, and funnels that value to larger, more sophisticated, more well-resourced, more well-connected actors. And in the past, all of these types of things have been about high frequency trading and some other esoteric problem. But now what I think Wall Street Bets has done, because it is a collection of average people, and not a collection of professional traders competing with other professional traders, but because average people have now reached such a large, prominent position in the market as a group through something like Wall Street Bets and the coordination that can happen there, and through the fact that that TradeFi and fintech and trading technology has finally reached such low costs, basically almost zero costs for participation by the average person. I think the average person has begun to participate in the market, and that participation basically has a very simple story. And the story is, when everything is going very well, they are participating in the market correctly. The market is able to meet their predictable expectations, and the more sophisticated participants in the market are able to essentially take their money most of the time. And then when the situation in the market suddenly doesn't benefit a select group of participants, the market system miraculously doesn't function. It miraculously doesn't work properly for many, many complicated, reasons around fees and clearing systems and volatility metrics and 50 other things. But at the end of the day, the net result is the same as the net result of censorship of communication, or censorship of social media, or censorship of really anything. It's the ability of the average person to participate in a system that they were told was fair and economically fair. I think this is the first very large realization. This is the first really large realization that Wall Street Bets is creating. And I think you'll see how these realizations then coincide around DeFi in a minute. I think the second large realization that hasn't been done yet, that hasn't happened yet, but which social media has kind of started, and which Wall Street Bets has proved can move into the non-social but the practical financial world, is that if enough average people believe in something, it starts to occur in certain ways. So if enough people decide to buy GameStop stock, something happens to it. If enough people decide to shift from one platform to another platform, then something significant happens in the world. If enough people decide that something isn't important to them, or they don't support something, then the world changes. And I think that force is really kind of a newfound force due to the fact that everybody now has a digital voice. And Wall Street Bets and Robinhood and GameStop and this whole kind of mini saga here just shows that also has an economic component. So it shows that social media doesn't just have a dynamic where people have a voice and that's all they have. But if that voice then leads to collective action through voting with your dollars, you then have a whole set of dynamics that traditionally people wouldn't have been able to coordinate or wouldn't have been able to do. I don't actually know what that means for society. I think both of these realizations are very powerful, because the first realization shows that there's a serious structural issue with how the current system works, and that's starting to be laid bare. And then the second realization shows that people have a choice, and they can have a significant impact on how the system works because they have that choice and they have a voice, and they can collectively use that voice to choose other platforms. And that this choice can happen very, very quickly, much faster than it could happen before. And it can change the way things work, and it can start to pervade really the entire world. It can just start to pervade the media cycle. It can start to pervade the debt cycle. It can become involved in politics. It's something that can happen much, much faster than it could before. And the way that this relates to DeFi is that DeFi is the system that all of these people want. It's the system that doesn't have the problems and the unfairness and the manipulation that many of these people experienced during the 2008 financial crisis. And it doesn't have the problems that they're experiencing now. And that DeFi system is becoming more and more accessible. So if you look at these two large kind of realizations from the Wall Street Bets, Robinhood kind of GameStop mini saga, what you see is that the problems of centralized finance have become laid bare to millions of people in the public media, and that's now starting to pervade into the political process. And whether those problems are with Robinhood specifically or some other part of a system, it fundamentally shows that the system is asymmetrically beneficial to certain parties. And it doesn't even matter if the system is structured that way or if you have society pay for bailouts or whatever you have. At the end of the day, this kind of song and dance about how the system is fine, don't worry about it. But at the same time, society bears the burden of debt cycles. Society bears the burden, or the average person bears the burden of financial systems working in a way that on a good day put them at a disadvantage to the bigger players, but then on the one day when they can actually get something out of it and be right, on that day they are also disadvantaged. I think that type of deal is a deal that second idea about collective choice will begin to reject. And if Robinhood isn't the case where people come to that realization, then there will absolutely be a second case and a third case. And at a certain point, I don't know where that threshold is, but at a certain point, at a certain case, everyone is going to realize that blockchains and smart contracts and oracles and their ability to make decentralized finance is the thing where this doesn't happen. It is the system where they can participate in a fair economic system with full transparency, full control of their assets, and a complete assurance that the things that they're participating in aren't stacked against them. And so I think that this has been happening for many years. You know, the 2008 crisis is an example of this. The stuff with Wirecard is an example of this. Robinhood is just the most recent, and Wall Street Bets and the dynamic around GameStop is the most recent. But it isn't going to stop. I think it's only going to accelerate. And with each additional realization of the lack of control and the paper promises that they have with people being faulty, with each additional one of those kind of instances, eventually those add up. Those have a cumulative effect where, people can only see something happen so many times until they realize the truth. And it becomes inevitable and self-evident what the real story is and what the real deal they're participating in is. So I don't know the exact threshold. I don't know how many more Robinhoods or GameStops need to happen, but I think we're well past halfway to the point where the cumulative kind of risk and the cumulative understanding of all this arrives at a place where decentralized finance is the thing that people want. They just don't know that they want it yet.
Amazing thoughts, Sergey. I'd love to drill down a little bit more into this. So, it feels like there's just been this amazing inflection point, right? So over the last 36 months or so, we have seen DeFi really explode and, become the key narrative of blockchain and crypto recently. And then, we've had what's happened with Robinhood, Wall Street Bets and GameStop. And so you've got this kind of inflection point where DeFi is now pretty much ready to scale. And now there's, as you've been talking about, this realization that the game is stacked against, let's say, the average individual Robinhood trader. So what comes next? How is decentralized finance better than centralized finance? And how does DeFi begin to really attract those users and pull them over from CeFi to DeFi?
I think the way this will happen is actually not even necessarily on the basis of trading. That might be part of it, and it might be trading certain assets of certain kind. I think the way it's actually going to happen is through yield and transparency and control of one's assets. So I think what is going to happen is inflation will increase. The yields of the global financial system will stay low and stagnant, which means people will essentially be experiencing a negative return. The returns of DeFi will continue to remain in the 3, 4, 5, 7, 8% range as more assets flow into the DeFi and the crypto format. And at the same time, each additional flashpoint of a Robinhood or a Wall Street Bets getting shut down through whatever reason, eventually the reason won't matter. It'll just be part of a mosaic of reasons that all have the simple message of, this is a bad deal for you as a user. And the reality is that the transparency of blockchains and therefore DeFi, as well as the control that people have over their assets in those systems, is going to be more and more attractive with each of those flashpoints. So I actually think there's two real cases for it. One is the ability to get yield, and that is the really strong economic case for it. And if you go to a bank account or you go somewhere and you get like below 1% or something like that, and then you can go and take your dollars and put them in a stable coin and put them into DeFi, and you can get 3% or 4%. People don't know where their savings account gives them a return from. They don't know if the bank does commercial loans or residential loans. They don't know the risk rating of their bank. They don't know the solvency of their bank. They don't know, how much assets under management by the bank. They don't know a lot of these things. And so eventually, I think what will happen is people will just provide an interface, or maybe even the very same banks will provide an interface that flows user value into DeFi as the superior source of yield. And in this way, DeFi will simply become the way that you get yield because it's the superior source of yield. And that is what the global financial system is very good at seeking out. It's good at seeking out yield. Now, that is the economic argument for why DeFi is better than CeFi. And right now, if you have $100, you can go get 5% from the DeFi ecosystem, whereas your bank will give you less than 1%, and in many cases less than 0.1%. And that's just a cold, hard fact that enough of the financial system doesn't know yet. And once they do, they will build interface upon interface to flow value into DeFi. The second one is more of a structural issue and a concern about counterparty risk. After you've had the water or the electricity or something shut off to you enough times, you start to think about moving. You start to think about moving somewhere else. You start thinking about getting a different way to get water or electricity. Once you experience something enough times, once you can't trade at a critical moment, once one of the institutions you thought you had money in becomes insolvent, once people experience enough flashpoints where they don't have control over their assets and they don't have an ability to really understand and manage the risk around their assets, enough of those flashpoints will make people very receptive to the transparency and private key-based control of a blockchain, which is what a DeFi application runs on. And this is why this is actually complicated for people, because we continue to explain a lot of this through the plumbing and the piping and all the systems underlying it. Like if you tried to talk to somebody, if somebody asked you, what is the internet? And you would say, it's a collection of protocols run by multiple servers and a client server model to deliver various types of data. People, even today with the internet as pervasive as it is, they'd be like, wow, that's confusing. But if you told them, you can order a pizza on your phone and it'll get to your house faster and be cheaper, they're like, wow, that's great. I want to do that. That's the new realization that is going to happen with financial products and really all contracts, including insurance and everything else. But if we just focus on DeFi, I think enough cases where people see this problem of not having control over their ability to interact with markets and not having transparency. Like, for example, with Wirecard. Wirecard was a completely separate issue where people thought they were solvent, but they were insolvent. And that caused massive problems for a lot of people. So there's these two problems, right? There's insolvency risk and counterparty risk because of a lack of control. And then there's, a lack of transparency. And then there's actually a whole other problem of having a lack of control over the system that you're using, and that system being able to be turned against you at a moment's notice if it's convenient for somebody else, but not you. And so the way that I think decentralized finance is better is, foundationally in a hyperinflation or a high inflation environment like the one we're rapidly going towards, people become very sensitive to maintaining their wealth, if not gaining returns, and everybody becomes sensitive to it. And that creates an extensive and sharper need for yield. And DeFi will be the place where that yield will be found. That's the base economic case. It's just a question of, do you want to earn 0.5% or 5% when inflation is eroding away wealth? And the answer is everybody wants to at least maintain their wealth. And so the place where the system through which they can do that will become unbelievably popular. And then all the flashpoints will slowly get more and more users into DeFi, but eventually there will be a tipping point where everybody just says, no, I don't want to use your TradeFi fintech centralized system because I just keep seeing people, have essentially their control and their wealth lost and eroded through a system like that. Can you give me a cryptographic guarantee instead of a paper one? Can your system guarantee me something on a blockchain to make sure that I actually have control of the assets? Can you guarantee me you're solvent through the transparency of a blockchain? And if the answer is no, that collective force in people's minds will eventually pass a tipping point where everyone just now starts to say, just like they started to say with the internet, send me an email. Now they'll just say like, no, can't do it. Can't do that transaction in this way. Have to have it reach this higher plane of trust and transparency. Because it's obvious that that's what I should do as a matter of using a product like this.
Yes, I very much agree with your thoughts there, Sergey, and I think it's just a matter of time as more and more people are realizing that fintech, for all its promises, was really just a shiny new front end on the old legacy way of doing things. It's not really an order of magnitude improvement at all, whereas DeFi is a brand new financial system built from the ground up. And I guess if we were to bring it back to Chainlink and what you have been working on for the best part of half a decade or so now, Sergey, it's the Oracle problem. So maybe if we bring it back to that, and I'd love to get your thoughts on Chainlink and I guess oracles and what role that the oracles have in DeFi and decentralized finance.
I think the simpler way to understand what decentralized finance is about from a technical point of view is to think about what the underlying infrastructure is. So I think you should really view blockchains as an equivalent to a database that's hyper transparent, hyper reliable, and basically guaranteeing you that it's going to do what it's supposed to do in all scenarios. Then you have smart contracts, which are pretty much application code. People should just view smart contracts as code, application code that, in the case of smart contracts, once again, by storing certain data in a database, like a token, and moving it around or some other piece of information, is able to create conditions, is able to create logic, and basically application code that also has these tamper-proof, hyper-reliable, hyper-transparent properties which make it unique. And the final piece of the puzzle, much like it was for the web world, is essentially APIs and the connectivity of systems, both between each other and to the external world's information. Oracles, which is what Chainlink is, oracles and oracle mechanisms are essentially highly reliable, highly transparent, highly provable APIs. They're basically mechanisms that take the world's APIs, take the world's data, take the world's information, and provide that information into a smart contract that's running on a blockchain or storing data on a blockchain in a way that meets that same high standard. And the way to think about this is that if you're making a system that's supposed to be hyper reliable, it's only as good as the weakest part of the system. Because when somebody tries to make a system unreliable, they don't attack the strongest part, they attack the weakest part. So if you look at what a DeFi product is, a decentralized financial product, whether it's insurance or something with trading or something with derivatives or something with lending or whatever it is, all of those products fundamentally need external data. If they don't have external data, if they don't know what the market price of an asset is, they can't settle. They don't know what interest to pay. If they don't know various market events, you really can't create a financial product without knowing those things, because that is what the financial product is based on and really representing in a consumable form in the form of a financial product. What Chainlink does is it essentially seeks to, and in many cases, in many ways has already solved the problem of hyper reliable connectivity with proof, with external proof, so that the database where the transactions that are related to a DeFi product are hyper reliable because they're in a blockchain. The application code of the DeFi product is hyper reliable because it's in a smart contract. And all the events and all the things triggering that application code is hyper reliable because it comes from an Oracle network like Chainlink. And without the hyper reliability of all three parts of an application like this, you don't have decentralized finance, because you need every part of the application to be decentralized in order for it to be decentralized finance, right? So this is, I think, the large innovation that's been happening over the past, 36, 48 months. We've seen that since we have went live on mainnet and released probably the largest amount of data, of off-chain market data into blockchains in history, we've seen a meteoric rise of a number of our biggest users because, and they credit us with this, because we provide the data that allows their markets to function, and without which those markets couldn't function and couldn't be secured to the tune of billions of dollars, which in many cases, certain individual Oracle networks, Chainlink Oracle networks, individually secure billions of dollars, and collectively well past $10 billion. And at the rate DeFi is growing, going far past that relatively quickly. The way to view this is that, if you tried to build Uber in the Web 2.0 world, and you didn't have the Google GPS API to show you where a user was, you didn't have Twilio to send a text message to the user, and you didn't have Stripe to pay the driver, you wouldn't have really built Uber. You would have built the Uber core code, and then you would have started building these three other key services, and you would have probably stopped halfway into building one, and that would have been the end of your venture. Because all of the services that are powering the web applications that we use on a daily basis are extremely complex, but they're packaged in a consumable, secure way for developers to plug them into their application, right? A lot of the applications people use in the web world are basically a number of other services, providing them data, providing them the ability to do a payment, providing them the ability to send a message. And this is how web engineers in the web world is built so rapidly and at such an iterative pace, at such a high quality of applications. Now, finally, the blockchain ecosystem, with the appearance of oracles as the services or the representation of services on chain that provide all of these external data sources and all these services in the real world to smart contracts, but through the appearance of all that, you basically have 2 to 5 person teams that can build world-class financial products without having to build the infrastructure to do that. That wasn't the case 2 years ago. 2 years ago, it was unbelievably difficult to build a DeFi smart contract that was connected securely to a piece of data. And the few people that did it ended up building some kind of decentralized Oracle system that in some cases, has already failed. In other cases, has large flaws that present serious risks to the value they secure. And I think it's through the systematic provision of more and more data, more and more services, that we are able to provide an ecosystem of building blocks that people then combine into high value, highly important decentralized finance applications.
Fascinating thoughts again, Sergey. Now let's go to a very quick break, and then we will come back and really want to get Sergey's thoughts on how he thinks DeFi crosses the chasm, goes mainstream, and we'll find that out very soon. Back in 1 second.
For crypto indices and benchmarking, Brave New Coin's powerful indexing engine can calculate high-frequency intraday and end-of-day indices for a wide range of index products. Brave New Coin's custom indices team delivers experienced consultancy, premium data, and trusted calculation. Contact BNC today to find out more.
Well, if we were to zoom out again, then Sergey, how do we actually cross the chasm, if you like? What do we need for DeFi really to go mainstream? So at the moment, there's, I think, looking at DeFi Pulse, just a little bit under 40 billion. worth of assets locked in DeFi at the moment. I don't know if you saw that just, I think yesterday or the day before, the Federal Reserve Bank of St. Louis in the US, they published a research paper on DeFi, and it was a positive piece of research, and they were very interesting, and so I thought that's a fascinating data point in itself. But obviously at the moment DeFi is intimidating for the average person, let alone anyone who doesn't know how to interact with Bitcoin. So zoom out, macro thoughts. How and when does DeFi go mainstream?
I think there's basically two cases for how this evolves. There's a fast case and there's a slow case. The slow case for DeFi is actually what we're experiencing now. As unbelievable as that sounds, going from something like 20 billion to past 40 billion this month, probably basically more than doubling in something like 6 weeks, is the slow case. And it is the slow case because, first of all, there is over $1.4 trillion in cryptocurrency value that is still not in DeFi. There's only about 2.5, 2.6% of the crypto value that could be in DeFi within DeFi. So that means there's a much, much further way to go. The slow case is really defined by the continual kind of slow failures and flashpoints of Wall Street Bets, Robinhood, GameStop, these types of things. Like this saga of people not being able to do what they thought they could do in an existing system will continue to mint greater and greater amounts of people that flow into the blockchain and the DeFi ecosystem as users that are willing to take the friction of using DeFi in hand and overcome it in order to get the better yields and to get the guarantees that they are so sorely missing in the traditional financial system. I think this group in the slow case will slowly be accelerated through better and better user interfaces. There are a lot of different wallets. There's a lot of different exchange applications. There's a lot of different sites that want to sell people cryptocurrencies. There's a large group of people working on that problem of on-ramping people. And I think eventually someone will figure out a way to just make it unbelievably seamless for people to interact with DeFi, such that the value flowing into blockchains will not be about getting a token that someone thinks will increase in value, but it will actually be about turning your assets into a token in order for you to interact with DeFi. So I think the real power of blockchains is not as a tokenization platform, even though that is very useful. It's not as a tokenization platform that allows the creation of tokens that may or may not go up in value. It is as a new kind of system of contracts for all financial products that have better yield, better transparency, and lower counterparty risk. And I think the interface, or the people making an interface that figure out how to simply say to users, look, you could deposit your money in your bank and you could earn less than 1%, have a ton of solvency related risk, and not really have very much control over your assets. Or you could take door 2 and you could have 5%, a lot of transparency, and relatively low counterparty risk. The people that can just make that value proposition apparent and clear and easily consumable to the average user will funnel a huge amount of value into DeFi as its own financial kind of layer. And that is the slow case, because there are all these kind of flashpoints of the traditional system not meeting people's expectations and the ability of DeFi to get better on-ramps. And so that's why that's the slow case. The fast case is basically some kind of correction or some kind of resolution of the debt cycle that is, for lack of a better word, jarring. That is just a kind of screeching halt in people's understanding and expectations of how the markets work, like 2008. And this will probably happen in one of two ways. Either there will be a huge market correction going back to to fundamentals, which will lead to a huge amount of solvency issues. That'll lead people to say, I don't know what my risk is, and lead them to seek places where they do not know what their risk is, which blockchains are inherently great at doing. Blockchains force transparency into the development of an application. And you can go and look at various protocols right now and see how many assets they have under management, what their exposure is on a minute-by-minute basis, see the changes in that exposure. In some protocols, you can observe why those changes were made through a voting process and a dialogue around that voting process, which is a huge shift from the amount of information and clarity that people can get from the traditional financial system. So the fast case is quite simply a rapid succession of failures in the traditional financial system, creating a fear of counterparty risk and a newfound cynicism about the solvency of traditional financial institutions and systems that rapidly lead, I would even say a majority of all people, to seek alternatives. And in that case, because the need will have become so pronounced, even if there is still some friction in the DeFi user experience, in order to escape the counterparty risk and the repeated lack of control that people have over their assets, there will still be a massive global migration towards the DeFi and blockchain systems that provide this. And the precursor of all this and the proof of all this is if you look at certain places that have systemic financial issues or have had them in the past, like Greece, Lebanon, and other places. What you see when the ATMs in those countries get locked up and there is a limit on withdrawals from an ATM from any one account, whether it's an individual account or a business account. So you could literally have a business and all you could get was 66 euros, which is kind of a mind-boggling idea. But two things happen in these geographies where these types of unfortunate systemic risks come to bear. The wallet registration numbers from IPs in those geographies go up by 300-400%. But the wallet registration numbers in the surrounding geographies that have not yet had their ATMs locked up, but are worried about having a similar situation because many of them are in a similar, kind of situation with solvency. Those geographies, like the neighboring countries around Greece and other places, start to see wallet registration numbers go up by 600, 700, 1,000%. And you can look all of this up from back when the Greek ATMs got locked up and a bunch of other things got locked up in Lebanon, Venezuela, and a whole bunch of places. I think that there's only two ways that gets resolved. Either there's a market correction and solvency becomes an issue, or people try to print their way out of it, and that creates a certain amount of inflation. In both cases, in both variants of the fast case, you arrive at a place where people seek alternatives and they will seek them very rapidly. And if you just think it through and you sit down and you ask yourself, well, what would happen if there was a serious crisis of confidence in certain financial products and certain parts of the financial system? What is the alternative to that? Where would users go if that happened? Immediate, obvious, and completely kind of singular answer you will find is blockchain-based smart contracts and decentralized financial applications. And so, I don't really hope for the fast case, because the fast case is going to mean another, painful restructuring of wealth and maybe socialization of certain costs and all kinds of other things, probably to do with inflation. But in the fast case, the one of the few things that can come out of it is kind of how the Bitcoin white paper is known to be birthed out of the 2008 financial crisis as something that was necessary. And so I think the next crisis, the next cyclical crisis that we're quite actually a little bit overdue for, so I think it's probably relatively imminent, is going to have that one silver lining, I think. that it's going to force the world towards blockchains and smart contracts and DeFi. So yeah, I think those are the two cases. I think the value here is so clear that people will adopt it slowly, and more people will enable them to adopt it slowly. And then I think the unfortunate nature of how markets work and how the debt cycle works and how a number of other risks kind of get compounded in the global financial system will lead to a correction of some kind. And that will possibly, on top of already a slow case that's happening, create a massive rush of a fast case. Which really is quite clear to me as something that has already been proven by the activity you see from people in countries that have had problems like this.
Fascinating indeed, Sergey, and I love these two ideas that you have with the slow case and the fast case, and I agree. The fast case is kind of that's the nuclear option, and maybe the slow case is the one we'd like to see. But even, I think, as you sort of hinted, even the slow case is still incredibly fast by the standards of technology, considering how much DeFi has grown to date. And just we've seen incredibly influential figures on the world stage. We've seen what Elon Musk has done this week with both Dogecoin and of course with Tesla and Bitcoin, and he's been playing around with wallets. And also Mark Cuban is another guy who is fairly deep in the Ethereum NFT scene. Hey, look, thank you so much for joining me today. It's been fantastic to catch up again and just really dig into where your thoughts are at with the state of DeFi at the moment. So yeah, really appreciate your time, and all the best to yourself and the team at Chainlink.
Great. Thank you very much for having me, Andy. Good to chat with you again. Excited to discuss all this. Thank you. Have a great rest of your day.
Well, there you go. How good was that? So good to catch up with Sergey and get his very interesting thoughts on DeFi and what happens next. I really hope you did enjoy today's episode, and if you did, please do subscribe to the Crypto Conversation in whatever podcast app you are using. But for now, that is us. We are out of here. See you next time. See you real soon. This was the Crypto Conversation for Brave a New Coin.